Broker Daily Uncut.
Broker Daily Uncut.
News, views and opinion about what's shaping Australia's mortgage and finance industry.
Welcome back. Great to have you with us. Broker Daily Uncut. We've got a cast of thousands today. Really pleased to introduce a new member to the team, or at least a new member to the podcast, to the team. Julian Barnes, very English-sounding name.
Hello. Good to be with you.
Senior journalist on Broker Daily. It's great to have you on the podcast. I've been propping this up for far too long. It's good to have somebody who actually knows what's going on around the traps.
Well, it's great to be on. Obviously, I've been behind the scenes doing the news for quite some time at Broker Daily, so it's really good to actually be on this podcast as I listen every single week. They say don't meet your heroes, but we'll find out today, won't we?
And of course, as usual, Eva, Costa. Yeah. Great to have you, gang. The absolute pillars of strength and information in this podcast. Quite a bit to talk about today. There's the usual ebb and flow of the markets. Auctions still going strong. It's we say every week that there's continued uncertainty about where rates are going, but people still feel it's a good time to buy. There's still, there's endless sort of stories about shortages in Brisbane and sort of pressure on prices. So things are ticking along, but we are seeing pressures. We'll have a chat a little bit around HEM further on in the show, but I guess one of the sort of things that has arisen is issues around suspected fraud. This has always been a significant consideration for every lender, and in the emergence of mortgage broking over the last 40 years or so, as a first point of entry for everyone, for 99.999% of people that come through the channel, obviously looking for the right support and the right channel to get their loan. But fraud has always been an issue, and I can think back. My wife actually went to broking for a very brief period of time in the very early 2000s, and back then, fraud, you could see when people had jimmied together, fraudulent generally salary, sort of pay slips. You could see, and you had to spot. And I actually went to we'll talk about CBA in a little bit, because this sort of circulates around CBA. But CBA used to put on back when Kathy Cummings was the head of third party there. CBA put together some incredibly valuable fraud detection seminars for the industry, brokers primarily. It's really fascinating getting to see some of the things that they deal with, that they're, sort of fraud prevention side, of the lender, really informative. But look, it's always been there, but, we don't see a huge amount come through the channel, but look, the issue is being raised once again. Julian, you've been sort of across this.
Yeah, so, this is something we've been looking at. It's kind of reared its head quite a lot recently. Obviously, the last week we had the UX data breach, slightly different, but the knock-on repercussions, you're going to see if should the data be leaked fully by the hackers, then you're going to see a huge amount of data kind of come onto the dark web and come onto the various actors, which obviously you've got this constant arms race between the banks, between organizations on one side that are constantly creating this incredible technology, fraud detection, education in the area. But then at the same time, you've got hackers, you've got fraudsters, you've got these different people that are constantly getting better. I'm interested from you guys. Obviously, we talked very briefly just before we started about, have you ever seen a fraudulent document? And it's like, I don't know, because maybe they're that good that you're not quite sure. And obviously with AI coming into it, and, everyone's always, sometimes people can be coy about how much they make or how much they spend. Do you think Eva and Costa, that you've seen that, or it could become more of a problem in the future?
Yeah, I think what I had seen in the past is like very obvious mistakes where, someone earns, I don't know, 100K a year, and then the year to date doesn't add up to technically how much they earn for the year. So often we would just go back to them and say, hey, can you make sure your employer update their pay slip? And all of a sudden they would be like, oh, I don't need the loan anymore. So obviously that means probably something was wrong with the pay slip. Now, if they are so good at doing that, making sure everything ticks the box, how would I know it's a fake, right? The thing is now, a lot of banks are now connective aggregator ask us to check that the salary that's on the payslip comes in an account. Like there's a few check we have to do. But if they're good enough to make everything tick the box, how would I know that it's a fake? How would I know that it's fraud?
It's an interesting scenario where you have different attitudes. You've got punters trying to get a loan and bending reality, which is fraud.
Yeah.
And I would imagine whether it's minimizing expenses, and it gets a lot harder to hide now, but, you used to get, people that would completely and utterly, sort of mask what their real expenditure was. They would omit, sort of outgoings. Technically that's fraud. It's not giving an accurate picture of your income and expenses. You've then got criminal activities, and that's a sort of a very different ball game to people trying to get a loan and trying to bend reality so they can get what they believe that they want and need, versus somebody who is actually looking to commit
crime and send money.
Crime, yeah.
Well, I found it, especially when I do SMSF, I find when it comes to SMSF, I know it's probably more of a regulated space when it comes to lending, but majority of those lenders actually ask for your bank statements to see your credits from the past 3 months, and which I guess, is trying to minimize that fraud, because like Julian said, AI is playing such a big part. Like, you can get a photo now and just tell it to say, you're at the beach, make a shark come up, and all right, it's probably fake because you're at Coogee.
Why would anyone want to do that?
Yeah,
but you don't need AI for that.
But like, it's so easy to do, and to the standard broker out there, or majority of brokers, we're not AI detection experts. No. So even if we look at it, and unless it's something like Eva where the year to date doesn't match up, you'd be like, okay, there's a reason why. Let's give them a call. But if everything matches up, it basically looks like a normal payslip. Yeah. So you can easily bypass that because we're just not equipped with the technology or the knowledge to be able to pick what's an AI payslip and what isn't.
I think this would be something really interesting to explore from multiple sources, just through Broker Daily, because I'm very out of touch now with what lenders and assessors are dealing with, and I think it would be I don't know if we've done this on a significant scale. I don't think we've ever done it through Broker Daily. I'm sure the advisors looked at this, but I think it'd be worth going to different sources, go to lenders, talk to brokers, talk to the aggregators,
see what kind of tools they actually have.
To see what comes through, and I think also, as you say, Costa, with this isn't people getting good at like photocopying things and jimmying stuff together. This is very. If you want to, you can create fakes with great sophistication using AI.
But it's getting so easy now, and something in the kind of wider society has been talked about is, should there be some kind of watermark that is a standard in AI, and that goes from anything from publishing to photos to art to there's all kinds of different things that we need to try and find some kind of data watermark that could work. Obviously, I understand that's a lot easier said than done, but in some way we need to be able to distinguish what is real here and what is created by AI.
Yeah.
Yep. But see, like now some lenders would call the employer as well. For example, in the case of a payslip, but you could give anyone's number. Like, again, everything has to be checked.
You'll end up with an AI caller on the other end at some point.
Well,
so I mean, like,
probably
it's really
will, because
it would get really hard to.
Like, especially these criminal groups, they're thinking 2, 3, 4 steps ahead. Yeah. So they're probably just like, well, let's create this fake number that goes to like this employer that we've put down, and it clearly is working because they have, CBA being recent, but it's happened to majority of banks where they believe it's up to $1 billion of their loan book that's been fraudulent. Amount. So they're investigating $1 billion. That's a significant amount.
And as I said, with the UX data breach last week, you saw real data being leaked, and then using that, you have every aspect of the client's details,
100%.
and that's something that brokers have.
Just talking about that $1 billion on their loan book, are they talking about complete nefarious criminal activity or just stuff that's been fabricated?
A bit of both, I believe.
Yeah, okay. Mm-hmm.
Yeah, they've been a bit vague in what they're saying, I guess, because they've reported it to the police, so
it's
they can't really say too much.
Right now, yeah.
And I get that.
In the greater scheme of things, as a percentage of their loan book, I'd imagine $1 billion isn't a great deal. It's $1 billion if you stacked it up in the middle of the table is a huge amount of money, but it's look, it's not a small sum, but I'd be interested to understand whether that includes people who falsified on a personal level how much they actually earn, and have misled the bank and deceived the bank and committed fraud, and how much of it is absolute, complete and utter criminal activity. But anyway, look, we'll maybe find out at some stage.
It's definitely a story to watch, because obviously they've just referred themselves. The whole thing's under investigation. We'll definitely be looking at where this goes on Broker Daily.
We'll take a quick break there, guys. Back in a couple of seconds. Welcome back. Great to have you with us. Negative gearing has reared its head.
Once again.
Somewhat with a due sense of weariness. Our government really, they dabble around, they play around in areas, particularly around taxation. Because the government's so bad at actually running the country effectively, there's this constant view of where you can wring more money out, plus, appeasing voters and winning a few votes. This is negative gearing, with yourself being English. I don't know how involved you were in property back in the UK, but this is a concept that I was, no one else has negative gearing that I'm aware of. But it works in Australia. It's so deeply woven into the fabric of our entire real estate ecosystem that
it came in a long time ago now.
Oh, it's been here.
I think it was John Howard that introduced it.
Yeah.
It's a very complex thing to unravel and to try and pack. And it dipping into this area lost Bill Shorten the election. Mm-hmm. It's a brave crew that decide they want to go back in there. But, it seems to be back in the limelight.
Is it something that's really entering the conversation? Obviously, it has been floated. Nothing has been decided yet. I think there was kind of a leak in the Labour government that says it is for the next budget. They are looking at it in June. Is it something, when you're talking to investors, is it something that they are genuinely factoring into their conversations yet, or is it still very much theoretical?
No, we need to, because when someone buys an owner-occupier property or an investment property or buys through a trust, the negative gearing rules are different, obviously. Mm-hmm. So we calculate servicing capacity based on how much negative gearing they would get. Obviously, the higher the interest rate, the higher negatively geared the property might be, and that can actually help the servicing. So sometimes you actually take them to a more expensive bank to help. There's lots to take into consideration there. If you buy a newer property, depreciation is higher. You can. It's a lot there.
There's so many moving parts.
Yeah, there's so many movements.
But again, the government's just looking through the wrong end of the telescope.
Yeah, well.
They're going, negative gearing, wealthy people, we need more money. We're wasting cash left, right and centre. So let's strip some more cash out. The bottom line is, anyone who's an investor will know that it is brutally harsh trying to get any kind of return on investment property. If you have debt on that property, sure, the super rich and super wealthy who have, zero mortgage down and unencumbered properties. Hey, well, guess what? Negative gearing doesn't affect them anyway. If you're trying to run an investment portfolio or an investment, you're providing much needed accommodation for Australia's renters. It is brutal trying to make the numbers stack up. You're getting hammered with land tax. If you've got property down in Melbourne, you're getting absolutely hammered with all of the compliance. You've got interest rates that are fairly punitive. Plus, and I won't get into this, for another podcast really, but the deductions that you get, it's very easy to go, oh great, rents are going up. You're getting yields are high. Well, yields get very quickly eroded through maintenance, through property management fees, through taxes, through.
It's hard to find a property that has a yield that's high enough these days, anyway.
And you end up, and you're going to end up with, it is already so difficult to decide to invest in property. You've got the government talking about mucking around with CGT and all sorts of nonsense being discussed. You've got to look at providing housing for Australians, and you've got to look at the housing market, not around the taxation issues. You're on a knife edge in terms of the balance of the property market here. We all know that not enough housing is created. There's complex reasons why that is. Housing is unaffordable. You need a stable rental market.
Well, going further, when Bill Shorten had when he wanted to get rid of negative gearing, he was just going to do it blanket, no negative gearing. What they've leaked out the past week is your first 2 investment properties, you'll be able to claim negative gearing on it. Anything after that, there's nothing. So they've tweaked it a little bit. I guess they just thrown it out there just to see what sort of reaction is they're going to get. And I reckon it's the same sort of playbook that they did with the CGT. Let's throw it out there. Let's see what the public is saying, what the media is saying. Are they pushing back? Are people getting angry about it? But like you said, I don't think the solution is negative gearing and CGT.
No, stop wasting money. Start running the government properly.
Stop wasting money and just, there's plenty of builders that want to build.
Taryn, aren't I?
You've been doing 20 podcasts with
I'm actually really not very political, but you kind of just get a bit frustrated.
It seems like the bit I'm confused in, I spend a lot of time talking to brokers both on negative gearing and capital gains tax, and it seems that they don't quite know what the aim is. Is the aim to rinse more money of the tax system? Is it to create more housing supply? Is it to bring? What is the solution?
Well, they say it's to create more housing supply,
but it won't.
But the reality, but this is the thing. The reality is it's a tax grab on property, and we discussed this a few weeks ago on the podcast where they always go after property because I guess everyone or majority of people have property, and it's an easy way to get money because if you're not willing to pay that tax, you'll sell it to someone who's willing to pay that tax.
But it's also being cynical. It's an easy way to win young votes because
100%.
you've got all these wealthy old people that hold all the housing, and we, the government, are going to fix it all for you young folk. And look, you just can't explain to people how it works because it's complicated. But the reality is, most young folks are going to need to rent for a period of time before they can afford to buy, unless they're able to stay, some sort of parental home. And if you mess around with CGT, then people just aren't going to sell property, So you're not going to create any more revenue. You're just going to sit on the properties. And then if you reduce negative, if you mess with negative gearing, there will just be less, less investment property available. I think a lot of it is, yes, there's a bit of a swipe at seeing if you can raise a bit of easy taxation, but there's also, I think it sounds appealing to people who don't understand
Absolutely.
the way that the economy
I talked to
works.
a broker about this the other day who specifically kind of went for first home buyers, and that was their main kind of forte, and he was very clear that he kind of said, look, there's a lot of policies right now looking at demand, bringing up demand. You've got the 5% deposit scheme, you've got all kinds of things helping people get into the market. There's not many policies that are bringing up housing supply. And as you said, this is going to actually strangle supply.
Well, it's so hard for, I'm aware of developers that want to build stuff, but it's so hard for them to make money because they've got to do so many certificates, regulations, taxation. So they're just like, well, it's not even worth for me to build. So all this is just literally a Band-Aid solution to what the actual problem is, which is government red tape and just allowing builders to build. Because if you make it easier for them, they can get up apartments and housing much quicker, which then brings more supply to the market, which in turn you would hope brings down prices or stabilizes them.
There was a bit of policy, I'm interested to hear what you think, in Western Australia. The Western Australian state government announced it's going to lift land tax exemption for eligible build to rent projects from 50% to 75%, applying to developments between 25, 26 to 29, 30, trying to bring up that rental supply.
Yeah,
what does that
good.
sound to you? Does that sound like a good idea?
Yeah, it is.
Anything that encourages provision of affordable housing. Anyone who owns property, of course, we want to see our property go up in value, but you've got to look at the whole ecosystem, and there is a horrible shortage of housing. Be it whether you want to sort of purchase to buy, or whether to provide affordable rental accommodation. And I think that as a sort of a basic starting point is certainly something which is a good move. We're gonna have to take a break, guys. We've got a lot to cover. It's all sorts of exciting things for the final section. Don't go anywhere. Welcome back. There's too many people here to mention all the names, so we'll get straight into the third section. Look, we've covered a lot of ground today. It's been interesting, and again, having Julian here has given a lot of I guess extra insight into what's going on around. But look, having you guys here Eva, Costa, as brokers, it's good to kind of dive into what's happening at the coalface. One of the things we've talked about over the last few weeks is, I guess, the changing rate environment. We know we've seen one rate increase. There's others being signalled. One of the things that you guys are affected with, as every broker, is pricing around fixed rates. You've been saying that they've been increasing over the weeks. What's happening at the moment?
Yeah, that's like the second cycle of fixed rate increasing. And then the big four have pretty much all done it last week again. CBA, Westpac, St. George, by 0.3%, which is quite a bit.
It is. So tell me, what are 1 year fixed rates looking like at the moment?
I mean, I actually couldn't tell you.
Have I thrown you a bit of a curveball?
Yes, I could not. I couldn't tell you anymore. It would be more.
But I'm going to guess, though, on that basis that people aren't taking out, because otherwise if people were grabbing fixed rates left, right and centre,
fixing. I think people are panicking. The one that are fixing now, the one that panic because
they missed the boat though for fixing.
That was
7-8 months ago.
Yeah.
But I feel 7 months ago there was talks of rate cuts.
This is the perpetual thing with whether you fix or whether you go. Yeah,
but I feel like a lot of first home buyers that bought maybe 6 months ago with a 95% loan, right up to what they could afford. Yes. And they see the thing going up and up and up. They might be fixing at 6.5, thinking, at least I know what I'm getting into.
The best time to fix your rates is 6 months ago.
Yeah.
Always. It's not a share market. I go, I wish I'd sold last month. So, and this is the perpetual thing. And I used to, when I sort of read all the books when I first started investing in property about everything from negative gearing to whether to fix and so on and so forth. And I started out by fixing because, you go down the pathway of having predictability about your repayments, and there's definitely merit in that. And I actually stopped fixing probably about 20 years ago because I think as long as you can withstand the increases as well as, taking the benefits of the decreases, you end up around about the same. I think historically, if you go variable or fixed.
Yeah. The only time I see a good opportunity to fixing, regardless of the time, and I've said that many times, is if you're actually an investor at 95%, a lot of the banks or lenders do not have on fixed rate the premium that you pay on variable if you are in an LMI territory. So in this sense, sometimes, and I think I mentioned it a few times with Phil on his podcast, like I think it was Bankwest at the time, almost at 1% difference. That's a lot, right? So if you're an investor and you get in and you're not going to sell the property for a couple of years, that could be worse.
Yeah.
Fixing. I don't know what it is at this stage with all the rates that have increased.
The issue with, again, without sort of going perhaps down the wrong avenue, but another issue that I always would have with fixing is if I suddenly decide I need to sell, then you've got break costs.
That's right.
Yep.
So there's
and you lose the offset
everyone
facility.
Everyone tuning in will know and understand this. But it's, again, sort of talking this through, the education piece with the customer. Look, brokers, can't advise whether you should fix or not. That's down to the borrower to decide. But it's a funny thing because everyone wants to save money, right? We all want to get the best deal. Oh, I should have fixed. There's great fixed rates at the moment, but it's not just about getting a great rate right now. It's about really what that commitment means. Sometimes fixing for 1 or 2 years can be, if you really know what your strategy is, can be a good thing, but you can end up,
Most people don't win with fixing.
Yeah.
The only time I think that was really good is when CBA had a 1.79% 4 years or whatever. That's before COVID.
Yeah, I'll buy that.
That was the only time that people did very well because then everything started
10
to go.
basis points. God, can you remember those days? Absolutely wild.
Yeah.
It's much easier back then.
And rates aren't going to go up, we were told by the RBA. Don't worry, gang.
Yes. 2 months later, 11.
Yeah, bang.
Yeah. But we were told the market would crash with COVID as well.
Yeah.
Could have been worse.
Life goes on.
Life goes on. So, so fixed rate have been...
so they're being tweaked, being moved up. Look, we know that it'll be interesting to see how far rates go. I haven't really sort of looked at the forecast. The last thing that was suggested was a May increase.
There's not much movement. I think maybe one is looking at another hike. Obviously, with the international situation right now, there is more talk again of hikes in the near term. I think March 17th is the next Next rate
Donald
decision.
bloody Trump. Oh, thanks. Yeah, we love your tariffs, mate. Now look what you're doing
So I saw
to everyone.
Stock market's doing pretty badly. Oil prices have shot up, and obviously that's always, when oil prices go up.
Not to mention, the turmoil that's being created. Anyway, we're not here to talk about about that. But yes, it'll be interesting to see.
Staying on fixed rates, the last time the banks were moving them up, we got the rate increase. So now they're, like Eva was saying, it's a second cycle where they're doing it again. So that is sort of telling me that they know that they're expecting the rates to go up.
Of course. But bear in mind that they can cut rates whenever they want to if they've,
of course,
if they've got it wrong, and it's
and it's just the customer that's stuck with it.
Yeah,
They
right.
don't care. They don't care.
Yeah.
I think every major now is predicting at least one more.
Yeah. I think
25 basis point
NZ
hike.
came up with it yesterday, saying it's going up again.
Just moving away from fixed rates just quickly. Eva, you flagged HEM. There's some changes taking place there. Do you want to just give us a bit of a...
Yeah, we've seen a bit of scrutiny around living expenses. So last week or earlier this week, Mass State, which is, not a lender we use a lot as specializing in investing, but they have increased HEMs. And, obviously living expenses are going up. So it does make sense. But in general, we've seen a lot of banks and lenders being very careful about how much people are declaring. If it does meet, if you're a family of 3 or 4 or 5, and they do check a lot more what's outside of the HEMS, which is, the basic expenses. How much do you actually spend on childcare? If you've got 3 kids on the street and you declare $500 a month, they'll be like, doesn't make sense.
Yeah.
We want evidence of that. Or if you have a unit, it's like $200 for strata per quarter. Well, no, it doesn't make sense. They're really starting to put like a judgment to the value you put there. Not just, you declare $6,000, family of 5, that makes sense. Now they're going into each category to really make sense. I had one the other week. The 2 adults work from home, so they have very little transport expenses. It was like $100 a month. They questioned me on it. I had to go back to the client to write an email to say, we work from home. We don't really go anywhere much. We don't have transport, fuel, whatever. But that seems very...
It's very interesting. I go back again. I bought my first place in 1998, and we were pretty much a cash economy then. Yeah. You had money in your wallet, and so a lot of living expenses came out of your wallet, and they weren't traceable. You'd kind of just got... online banking was in, but it wasn't the norm back then. So a lot of people tuning in some people are going to remember those days, but the world's changed a lot. So you used to have to trust the borrower to give you a living expense. You go to the supermarket with money, and you'd pay for all your items at the supermarket. You go to the bottle-o, you'd pay for everything with cash. Then you'd have, and even you'd even pay, you pay your utility bills. It was only really big expenses and regular items. There was no streaming. There was none of the subscriptions that we have now. Everything is digital. Your digital footprint is very significant. Yeah.
And some lenders still ask for last 30 days bank statement to see your expense. And if anything is out of the norm, they will explain why. Is it one-off? Have you, gone traveling or gone out in a way that you normally don't? So I find that's becoming a bit more on the assessor's mind to really check, buffers. So let's see what's coming with that. I feel like banks are moving, and obviously living expenses have increased with...
Who do you think, which kind of cohort of borrowers do you think this is going to be the biggest sort of issue for?
So with the investors, especially when they're close to the 6 DTI, that's where banks and assessors really dig in and make sure that it works. I think that's where it will happen when people have tight servicing or investors with high DTI.
Yeah.
That's where we're going to see that happening.
I reckon that's all we've got time for, gang.
Time flies.
Time does fly. Time does fly in the podcast room. It's like kind of a warp where you lose all track. No, look, Julian, great to have you with us. Thank you very much. And we will see you again next week. Eva, Costa, as always, an absolute pleasure. For everyone else, thank you so much for tuning in. We really do appreciate your joining the podcast. I love chatting to these guys. I learn a great deal. But, it's the audience that counts. We will catch you next week.
The information featured in this podcast is general in nature and does not take into consideration your financial situation or individual needs and should not be relied upon. Before making any investment, insurance, tax, property or financial planning decision, you should consult a licensed professional who can advise whether your decision is appropriate for you. Guests appearing on this podcast may have a commercial relationship with the companies mentioned.